One of the financial instruments we know is bonds. We're going to discuss those bonds. Not those bonds, even though it would be a lot of fun to discuss the movies, but we're going to talk about different kinds of bonds. Bond is a certificate of indebtedness. It's a promise to pay you back a certain value in the future. So bond is nothing else but a piece of paper that says that I promise to pay you back a certain amount in the future. The future is going to be determined by the maturity rate. Maturity rate is in how many months or years I promise to pay you back. And I also promise to pay you interest rate, or we call it also coupon rate. So every year I'm going to be paying interest rate because you allowed me to borrow some money from you. For example, if you buy a bond for $1,000 that has interest rate of 6% and maturity rate of 5 years, it means that every year you get paid 6% of that $1,000, so $60 you get paid every year, and in 5 years you get your $1,000 back. Depending on the interest rate, bonds can be sold at the face value, discounted value, or premium value. So it's not necessarily for you to wait until the maturity rate to get your money back. Sometimes we want to get our money back faster, and then we have to sell that bond. And you can receive either face value, discounted, or premium value. How this value of the bond is going to be determined? It's going to be determined by the interest payment, that coupon rate, and the current interest rate. Let's look at the example. We're going to look at the example where a bond has a face value of $1,000, a coupon rate of 6%, and the current interest rate is 8%. So what is this information is going to tell me? That my bond pays me 6% interest rate every year. I'm trying to sell it. I'm trying to find the buyers for my bond, somebody who will give me $1,000 back, and they will start receiving that 6% every year. But the current interest rate is 8%. So if that buyer is going to put their money in the bank, they would be earning 8% every year. My bond will provide them with only 6%. So what do I need to do to convince them to purchase this bond from me? I have to unfortunately sell it for lower than $1,000. So we would pay less, so people would pay less for this bond. In order to determine the actual price of the bond, we're going to use a simple formula. It's the interest payment, that coupon rate, divided by the current interest rate. So in our example, that interest payment is equal to $60 per year. So 6% out of $1,000 is going to be $60. We divide it by the current interest rate in decimal point. So if you want to sell this bond, you can only ask for $750. Otherwise, nobody who can do the math is going to be willing to purchase it from you. What if interest rate is 4%? It means that if a buyer puts their money in a bank, they're going to make 4%. If they purchase your bond, they're going to make 6%. Now your bond is more attractive option for those buyers than putting the money in the bank. So they will be willing to offer you more than $1,000 in order to receive your bond. So you can also calculate it, that if the new price of the bond is going to be $1,500, that coupon rate divided by the current interest rate equals to $1,500. So we can see that bond value increases when interest rates decrease, and bond value decreases when interest rates increase. Next thing we're going to discuss is stocks. Once again, not those kind of stocks, different kind of stocks. Stocks that is a claim of a partial ownership of a firm. Whenever you buy a stock, you pretty much buy a small teeny tiny part of the company. We say that stocks are riskier than bonds because with bonds you are guaranteed to receive that coupon payment every year. With stocks you are not guaranteed to get your money back. Stocks can increase or decrease in price. Also, you may either have no return at all, no dividends, or you can have pretty high return dividends. So we're not guaranteed to get your money back. So stocks are going to be riskier than bonds. In general, price of a stock is going to be a reflection of firm's future profitability. So whenever we determine the price of stock, we're thinking, is this company going to be able to make money in the future? And if we think yes, more people would like to buy those stocks. More people would like to buy, demand for those stocks will increase, and as a result, the price of that stock is going to increase. Vice versa may happen. If we don't believe that this company is going to be profitable, we want to get rid of the stocks. We're going to start selling the stocks. When we sell the stocks, we increase the supply. As a result, price of the stock is going to decrease. So what goes into the determination of this price of a stock? Fundamental analysis. It's the study of company accounts and future prospects. Stock price per income per share ratio. So we're going to determine how profitable the company is going to be based on the company's current standing. We're also going to look at its competitors. How are they doing? And that will tell us something about our company. Management. Whoever is managing this company can also affect it. You don't want a manager to be somebody who's known for the bankruptcy, or you don't want to be somebody who's making risky decisions without any positive ever coming out of it. Credit risk also is going to go into the determination of the price of a stock. And as we said, supply and demand is going to play a crucial role in determining the price of a company. So depending on how much people want to buy and how much people want to sell, the price is going to differ. When it comes to the supply and demand, here we have such thing that we call efficient market hypothesis. That tells us that asset price will reflect all publicly available information about the value of an asset. In your book, you saw the gray cheap house example. If your realtor is trying to tell you about a certain house that is very much undervalued, that is going to increase in price within a year, you're going to start thinking, well, if that house is that great, why is realtor not purchasing that house himself? Why is he trying to sell that house to me? Why is he not motivated by making profit himself? The reason maybe he's not revealing all of the information. What efficient market hypothesis is telling us that the price of an asset, the price of a stock, is going to tell us everything about that particular stock. So there is no hidden information involved. Another example that you saw from the book was a $100 bill lying on the street, right? Two economists walking by and they say to each other, well, if it was a real $100 bill, somebody would have picked it up already. That's how economists think. And that's how, once again, we go back to this efficient market hypothesis. It's almost impossible for that $100 bill to lay on the side of the street because somebody would have picked it up. The same when it comes to the prices of stocks. There's no such thing as a particularly good stock to buy. There's no such thing as particularly bad stock to buy. Because the price of the stock tells you about the real value of that stock. So it's almost impossible to make a lot of profit by trying to figure out which stocks are better to buy, which stocks are not so great to buy. Finally, market irrationality is going to go into determination of a price of the stocks. Emotions drive people to buy or sell stocks. If everyone's doing it, I might as well do it. If everyone's doing it, it must be a good thing. So a lot of times we are artificially driving the prices of stocks either up or down. For example, we saw that with the dot-com bubble crash. bubble and crush. So many people were thinking that if something has a .com attachment to it, it's a great thing, it's a great company, and we have to buy that stock of that company. As a result, there was an artificially high demand for those companies, whether those companies were actually not able to produce much. As a result, market crashed. Those people lost their money. We artificially increased the price of those companies. You can also talk about house markets crash. That works similar to that. Artificially increasing price of the market. Let's buy. Let's increase demand really high. What we saw at the end, it crashed. So market irrationality also is going to play a role in determination of a price of stocks.